This is the current federal tax developments for the week of November the 18th, 2019. Current federal tax developments are brought to you by Kaplan Professional Education and by your state society of CPAs. I'm Ed Zollers, and I'm going to be talking to you this week about what's happened in the area of federal taxes. One thing that happened last week that we'll talk about is the AICPA held their annual National Federal Tax Conference. And at that conference, a couple of sessions that were reported on this week tell us about some stuff that should be coming up. So we'll discuss what's going on there. The IRS told us that they are going to be going after syndicated conservation easements. We had a case that the IRS lost on a son of boss transaction where they were trying to deal with, or trying to say there was an extended statute of limitations. They ended up losing for the second time on that case. And the IRS rolled out the adjustments to get the auto mileage revenue procedure that we use for taking standard mileage rates, to update that for the fact that certain things under the Tax Cuts and Jobs Act aren't going to be deductible anymore, like those employee business expenses. Well, this coming week, we're going to have a few things happening to us here. And one of the things going to be happening here for us is that we are going to be going out to Minneapolis this week to have a session there in Minneapolis. And I should say, last week I recorded a session for Arizona that we did. It was 199 CAP Explained. We are going to be broadcasting that session that you can sit through it on Cal CPA's rebroadcast. That'll be happening on Tuesday, November the 26th. The session will start at both 6 a.m. and 8 a.m. Pacific time. Adjust that for your time zone. Most of the state CPA societies that I work with broadcast Cal CPA programs as well, so you check with your state society. There should be a way to sign up for this. Again, it's a rebroadcast of what happened last week. It does count for live credit under NASPA standards, because we're going to have somebody there to answer questions. That somebody is probably going to be me, looks like. We'll be there to answer questions on text back and forth, for email stuff. We'll be doing those sorts of answers, get to you. If they're more complicated, we may email you back. If it's one that can go in a nice text box, we text it back. But if you want to go to that course, pick up stuff on 109 CAP A, the Qualified Business Income Deduction, you can join us there on the broadcast on November the 26th, 6 a.m. Pacific, 8 a.m. Pacific, for the broadcast on 199 CAP A's issues. With that, let's go ahead and get started and take a look at what's happening this week. And the first thing we're going to look at is that we have a story that was posted in Tax Notes today. Kristen Perillo had a story, Carried Interest Salt Among Imminent TCJA Guidance. It was posted on the 14th of November. And what the story talks about is guidance that was given at the AICPA's National Conference on Taxes. It was given by Treasury Assistant Secretary David Cotter. You may remember he was the interim commissioner up until Commissioner Rettig was confirmed by the Congress, actually, so it was appointed and confirmed by the Senate. And he was talking today, though, back in his job in policy, he was talking about those things the IRS expects to get done by January 2020. Some of the things he tells us we expect to see, a big one maybe probably waiting on, are the regulations under 163J. That is the business interest limitation. If you've been waiting on those things, all we had is proposed regs. Now, remember we had that for last year. They are working on final regs. Again, stories continue to come out that these final regs will be much changed from the proposed regs we had. And the basically Assistant Treasury Secretary tells us that right now these regulations are 550 pages long. It's going to be a lot of stuff to study. We still don't know if the effective date of these will be for the 19 returns, be electively for the 19 returns. We'll delay to the 20 for everything. We don't really know what's happening, but there's a reasonable chance it will either have to be used for 19 or will be allowed to be used for 19. So you're probably going to have to study up when those come out. And again, they may very well drop out in January, just like the 199 CAP A final regulations dropped out last year at the last minute for us. Other things, we expect to have proposed regulations on the carried interest rules. You may remember that Congress, or not Congress, but the IRS told us, a lot of people said, look, the carried interest rules for partnerships, these rules say that essentially if you have an investment partnership or you have a real estate partnership and a partner got their interest essentially for services, and they got their interest for services. They didn't get interest in capital, so they got a profits-only interest. They're going to get an allocation of income from the partnership. And some of that allocation they're probably hoping is going to be either qualified dividends or long-term capital gains. Well, the carried interest rule says that if for any sales of property there, you're going to have a 3-year holding period, not a 1-year holding period for that particular partner. Those are carried interest rules. Some people noticed that the carried interest rules, basically said it didn't apply to corporations. That caused some people to say, well, they didn't exclude S corps, they put them in S corps. IRS told us right off they don't think that's right. They want to shut that down. Well, we may find out when we get these carried interest proposed regs how the IRS will actually plan to try to shut that down, and then probably more importantly, whether we think that's probably going to work. The IRS also is telling us the final opportunity zone regulation should be out by the end of January. We hope it'd be earlier than that because, of course, as you're probably aware, due to the way the rules work, that second basis jump, the 5% one, remember, you sell something at a gain this year, you reinvest the capital gain, you hold the property for 5 years. We basically are forgiven 10% of that gain. You hold the property for 7 years. You're forgiven another 5% of the gain. But the problem we have is when we get to December 31st of 2026, we have to recognize any gain that's still outstanding at that point. And of course, the problem is that it's going to be less than 7 years from the date you would have purchased your qualified opportunity fund unless you can get into it, basically this year. So that's why we would love to see the final regs here so we know what all the rules are before we have to make the call. It's probably going to be close if we make it before the end of December. It wouldn't be totally surprising to see it go till after the end of December. We also have new regulations on the $10,000 cap on state and local taxes. Now, again, we don't know if this has anything to do with a project that is currently sitting at the Office of Information and Regulatory Affairs of the Office of Management and Budget. It's titled Treatment of Payments to Charitable Entities in Return for Consideration, TCJA. That went on October the 29th. If so, we could have some revisions to the rules on charitable contributions that you get a state tax credit for. That could be sitting in this thing. We don't know much about that project, but it was interesting that the Assistant Treasury Secretary did mention that some new state and local tax rules are likely to be out before the end of the year. We also have a number of other issues. Some of them there, like you have regulations on computing unrelated business income for a tax-exempt organization that has multiple trades and businesses. That'll be in there. We'll have some regulations on withholdings under 3402. We're going to have, kind of the increased basic exclusion amount under Section 2010 for estate taxes and gift taxes. We'll have a number of these things that we'll be getting by December 2020. I would certainly expect that there will be a lot of reading to do before tax season gets underway. So, hopefully you don't have anything planned from basically the last couple of weeks of December right up until you actually get flooded with all those tax returns, because you may have a lot to digest in that time period. We've had a series of private letter rulings the last 2 weeks. We had them, these that came out on the 11th. I'm here recording this morning, the 18th. We have another series of these today, but I'm going to pull one of these. This is private letter ruling 2019-45001. This was issued on November the 11th, 2019. We have seen now a series of these, and they continue to come out. I don't know if they're going to continue to come out next week, but we certainly have had a lot of them the past couple of weeks. What we're seeing right now is these relate to some issues for investment advisory fees. As you're probably aware, investment advisory fees generally are considered expenses under Section 212, expenses for the production of income. For individuals, generally, 212 expenses, unless they relate to a rental or royalty activity, are considered to be miscellaneous itemized deductions. They were, prior to the Tax Cuts and Jobs Act, what we would have called 2% miscellaneous itemized deductions. That is, we had a 2% haircut. As you're probably also aware, Section 67G, as amended by the Tax Cuts and Jobs Act, totally wipes out the deduction for those items until we get to 2027. So you're going to be back in that standpoint, or 2026, I should say. So we're losing them totally. Well, this ruling is looking at a PLR request regarding an annuity product. As you're probably aware, what we call non-qualified annuities, that is annuities not in a qualified retirement plan, are taxed generally under special rules. Under those rules, it's considered to be a kind of black box investment. You put money into the annuity program. Things happen in there. No current taxes charged on whatever happens in there. And then years later, when you start taking the money out or you cash in the annuity, then at that point you will recognize ordinary income. And that ordinary income will generally be based on the ratio of what you expect to receive or actually do receive if you cash the whole thing out on the annuity compared to what you put in and purchased had basis in it. Well, what they're asking to do with the annuity here is they have a variable annuity that is designed to be used in consultation with an advisor that will give the owner of the annuity advice as what choices to make. Because a variable annuity, you have choices of different funds you could invest in inside the annuity. So the advisor is going to help them talk about that, give them advice on that. In this case, they want to pay for that advice by charging that a charge to the annuity program itself. So the annuity program itself will have this pick it up as a charge to the account. And ultimately, as you can expect, that's going to reduce what's available at the very back end for distributions. So indirectly, you're getting a deduction for those payments on the theory that we don't have to treat, this counts as a valid expense of the annuity, we don't have to treat it as a distribution taken to pay the advisor. Well, the IRS said as long as the only advice being given is with regard to this particular annuity product, you can't use this to expand out and cover all the other advice they'd give. It's got to be limited to the annuity product. But if that is true, the IRS found that in this case, that's not a taxable distribution. Now, the fact that we have seen a series of these suggests that at least some annuity company has got a lot of specific products that they're going to look at using this sort of pay the advisor via a charge from the annuity fund, and then probably turn around and use that as a marketing benefit to say, look, come with us, don't invest outside the annuity. Invest inside our annuity, and if you do that, then you're going to effectively get a full deduction for the advisory fee. As always, that's correct. I agree that you'll get the deduction. Whether that makes sense depends on whether the annuity program in and of itself makes sense, which is a totally different question. Remember, getting a tax deduction is no great big deal if you're linked to an investment that itself isn't a very good investment. So, the tax deduction for the fees charged against the annuity will never pay for the fees charged against the annuity. First thing is, so you certainly aren't going to make money by using this investment routine. But if otherwise the investment works out, then yes, it does appear that this may be a way that insurance companies and others who push annuities may have a way to provide for payments for investment advice, and doing so in a way that reduces the amount that the individuals will eventually pay in taxes at some point. Next up, the IRS had this week issued a news release, IRS News Release IR 2019-182. The news release was entitled, IRS Increases Enforcement Action on Syndicated Conservation Easements. It was issued on November the 12th. Back in 2 years ago, the IRS issued Notice 2017-10. It created a new category of listed transactions. These listed transactions related to syndicated conservation easements. As you should be aware, we have a special rule under the charitable contribution rules that you can get a deduction for a gift of what's essentially a partial interest, which normally is blocked, if you make a gift, a permanent, unable to be revoked gift of a conservation easement to a charity, one that would make use of that conservation easement. For instance, you might give some lakefront property to keep it from being, so therefore it'll never be developed. That'll preserve it for nature, for natural park purposes or for wildlife, etc. And if you do that and you make that contribution, even though you may still own the surrounding property, because you have given this easement on your property, you could be allowed to be given a charitable contribution. Now, what happened is, of course, that certain promoters started picking these things up and they packaged them and they put them into tax shelters they could market. And what they would tell people is, give us $10,000, give us $100,000, let's say, and we will give you essentially a $250,000 deduction when the contribution is made. IRS considers that is abusive, and that's why it was on there. So we have these issues where if a deduction is greater than $250,000 of the investment, it's considered to be a listed transaction structure, and we should be doing these things. Now remember, as a listed transaction, you should have filed a Form 8886 with each return that had one of these on it, for which some tax benefit would be claimed. And if you didn't file that 8886, then the statute of limitations does not run out for an assessment based on that until at least 1 year after the time you finally file that 8886. And the other issue is that you are going to be subject to penalties generally equal to 75% of the tax benefit that you expected to receive, or you received on the return you filed for this particular contribution, for this particular transaction, for failing to disclose it. Now, the IRS encourages taxpayers who may have invested in these things to amend the return to remove the deduction. But the unfortunate side effect is that may not fix the penalty problem if the Form 8886 wasn't filed initially when it should have been. And remember, it had to be filed for any returns filed after they put that notice out, but also any returns whose statute of limitation had not closed by the time that notice came out. You were supposed to notify the IRS on 8886 that you had a listed transaction on the return. I expect a lot of people didn't do that. So I would say before you just went ahead and amend a return, you might want to check with legal counsel, try to figure out, what the best approach might be for handling this because of the risk on the listed transaction rule. But the IRS is getting serious here. The IRS and the Department of Justice have had some success in this area, right? They've been very active in this area prior to the announcement. They've had success in pursuing this area. It's probably one that, your client was in that. Your client should recognize now that there's a reasonable chance that, the IRS is going to come calling. And yes, you will discuss, should we amend and remove those deductions just to get ahead of them and hopefully avoid penalties. Well, the next thing really isn't as big a thing. It's the IRS simply cleaning up something that's kind of been needed to be cleaned up ever since the Tax Cuts and Jobs Act passed. This is Revenue Procedure 2019-46. It was issued on November the 14th. And what this ruling talks about is it just updates Revenue Procedure 2010-51. That is the current, or used to be current, revenue procedure that outlined how you could use a standard mileage rate to substitute for certain, for the full documentation requirements on the use of a business car in certain other areas. Now, the problem is, of course, that was written back in 2010 when, if you were an employee and you incurred the mileage, you did put that on a 2106, you'd get a current deduction. Hey, we're happy. The problem, of course, now is that you don't get a current deduction on a 2106. If it's a miscellaneous itemized deductions, you're going to lose it. So the IRS is modifying this procedure to take into account changes made in the Tax Cuts and Jobs Act. The key changes they're looking at for the most part is the fact that miscellaneous itemized deductions are no longer allowed. So it tells us specifically, it knocks out and says, look, you can't use business standard mileage rate to claim a miscellaneous deduction during the suspension period. You may not use it, right, for parking fees and tolls related to the auto to get a deduction for that if it had been a 2%er. They tell us that we can't use it to claim the standard mileage rate for unreimbursed travel. We can't use it, for anything else. It would be a 212 expense. And they remind us that we also can't use the mileage rate for moving expenses because they were also removed by the Tax Cuts and Jobs Act. So unless you qualify, like, military moves still qualify in some cases, you're not going to get those things. This was just a cleanup ruling. It's not a brand new set of mileage rates. That comes later. It's just a ruling to clean things up. There are some minor changes otherwise made to it, just some cleanup issues. But very little here did not relate to TCJA. Doesn't really change much. It's just remind you that the rules are there. And when you go look for the rules now, you're going to move forward to 2019-46 is where all the formal detailed rules are prior to getting the updated mileage each year. Finally, we're going to take a look at a case, Beverly Clark Collection, LLC versus Commissioner, Tax Court Memorandum Decision 2019-150, issued on November the 15th, 2019. This is actually the second time this particular taxpayer and this particular transaction has come before the United States Tax Court. And it came back because it went up to the Ninth Circuit. It also, at the same time, was impacted by a Supreme Court decision that came down while it was still pending at the Ninth Circuit. Eventually, the Ninth Circuit handled it and asked the tax court to consider one other option, which they sent it back for. Well, the catch of this is one of those son of boss transactions. Son of boss transactions, you go through a series of transactions and you can read about it in the case, but fundamentally you're going to inflate the basis inside of a partnership. You're going to use various mechanisms to create basis out of thin air. And why would you want to do that? Because you're going to incur a large capital gain. In this case, they were going to be incurring a large capital gain that they wanted to get offset. And the key issue in this case, they owned a welding accessory business, the Beverly Clark Collection, which they operated as a proprietorship. They transferred those assets to the LLC. The LLC then entered into an arrangement dealing with treasury notes that they claimed created a basis inside the partnership. Then they were able to sell the parts off, sell things to another party, and essentially reduce by 80% the gain they were going to recognize on the sale of the proprietorship business. That's how the IRS did it. Now, the IRS went after this because the son of boss transactions have not fared well in court. That's putting it mildly, right? And pretty much the courts have agreed, and nobody's disputing in this case, that the transaction itself, or at least we never got to the point we dispute it, that the transaction itself was probably not going to accomplish the tax benefit that was promised. But the problem is the IRS took some time getting the notices out. This happened in a lot of cases. By the time they actually got to the partnership issue that was in front of them, the standard 3-year statute was going to have expired. So the IRS in this case, and in this case the 3-year statute had expired. So they issued it after the expiration of that normal statute. Now, some of you may be aware that the Internal Revenue Code has a secondary extension, section 6501. If a taxpayer has omitted 25%, more than 25% of the income that should have been on the return, then the statute of limitation goes from 3 years to 6 years. So here was the catch. We have here this particular transaction. The IRS issued after the expiration of the normal statute, before the expiration of the 6-year statute, not 3-year if you're reading a slide, but the 6-year statute. And so the question becomes, if they did that, was the omission of 80% of the gain considered to be a 25% omission of gross income that would open up the 6-year statute and that would allow the IRS to assess the tax? To be frank, it's almost certain that if that statute is open, the IRS will win the case, because essentially it's going to be very tough to defend this transaction. It hasn't fared well, and there's little reason to believe that somehow magically in this case it would fare well. Probably wouldn't fare very well. So we have to look at that in this case. But here's the catch. The IRS, while this went to court, the tax court originally said, sorry, IRS, an overstatement of basis is not an understatement of income. Now, the IRS issued regulations to try and change that result, because that went back to an old case called the Colony case from the U.S. Supreme Court. And the U.S. Supreme Court in the Colony case had said that the law was not clear, but that because the law was not clear, they thought, though, the best result would be to say that what we're really looking for is the IRS made aware of the transaction. We have this special rule when you omit income from the return that the IRS may never be aware there might have been income there because you hid them from them by not reporting it on the return. So they said, we think in this case an overstatement of basis would not be a problem, because overstating basis, you have the sale on the return. Since the sales proceeds are on the return, the IRS is aware there's been a sale. The IRS should be aware that there's time to challenge this. Now, when the appeal first went up, the IRS, and the IRS, by the way, also argued it was a sham transaction, and therefore there was an omission of sales price effectively with this structure. When it first went up, the IRS argued both. The tax court only decided on the first point, saying it wasn't an understatement of income. Now, while it was up there, the Supreme Court issued their decision in the home concrete case. Home concrete back in 2010, the Supreme Court said the IRS regulations were in error, that the IRS regulations essentially, even though there might be ambiguity, and even though the IRS interpretation might be reasonable, the four of the five justices that voted in favor of basically throwing out the reg said, but even though it's ambiguous, sometimes even if ambiguous, there's still something that is a better meaning, shall we say. Even though the IRS interpretation is reasonable, there might have been a clearer meaning. And that was one of those funny opinions that Justice Scalia, the late Justice Scalia, he voted with the majority, but he said essentially, you got to be kidding me. We had said in the Mayo case that if a statute was ambiguous, then if the agency came up with a regulation that was reasonable, that the fact that it was a reasonable interpretation, regardless of where there might be other interpretations, we would follow that reasonable interpretation to resolve the ambiguity. Justice Scalia noted that if you were going to be consistent with that case, you would have to support the IRS's reg here. But he also said we've had Old Colony for decades, and what you guys should have said was the long history of Old Colony makes it not like, basically we shouldn't change that because people have relied upon it. But if you don't like that theory, then really you should have voted with the minority side, the dissenting side, and said that the regulation was good, because that's in line with your decision in the original case, and the case going back when we had it in the Mayo case, saying the consistent result would be to say that, yeah, the reg's good because, like Mayo, the IRS is interpreting an ambiguous clause. Well, whatever on that. The IRS dropped that argument at the Ninth Circuit that their overstatement of basis, was considered to be an omission of income. But they argued, look, there was this sham transaction in the middle of all of this. The whole thing was a sham. So this supposed sale, which when the partnership got done, we only basically allocated 20% of the gain to the taxpayer from the supposed sale. They're saying they really omitted 80% of this transaction. And their theory would be, well, the IRS's view would be, yes, okay, we already said, so it wasn't really an overstatement of basis. It was a sham, and we totally omitted 80% of the sale. That omission would be an omission of gross income. That's the IRS's theory. The Ninth Circuit said, tax court, you didn't rule on this view. Please rule. The tax court took a look at it. Tax court held in this case that such a situation as that is merely a misstatement of gain, not an omission of the income from the return. And because of that, the IRS, because the sale was effectively reported on the return, the IRS was totally aware that there had been a sale. They were not disadvantaged not being aware a sale was there. They could see the reported basis. They could see the reported amounts. They were told all this stuff. If they wanted to, they had the information to suggest that they might want to consider challenging it. They didn't. Sorry, IRS, we're not going to let you do this. Now, is that going to hold up on a review going back to the Ninth Circuit? I don't know. It could be interesting. But don't be surprised if the service takes it back to the Ninth, and don't be surprised if we talk about the Beverly Clark collection a third time, for a third different ruling about how that would work. Again, we are now in serious CPE season, right? We're coming here into the latter part of November, and, time's running out for you. If you're the one that likes to get your CP done before the end of the year, or you've got a renewal date at the end of December, remember, we got Thanksgiving week coming up. There's not a whole lot of CPE that week because, basically people are traveling, they're doing other things, so we don't have a lot of courses offered that week. So that means effectively you've got this upcoming week, and then you probably have the first 2 weeks in December, and after that, won't be much once we get very close to the Christmas holidays. Won't be much the week before the end of the year. So if you need to get CPE by the end of the year, you should be looking now at your state society's catalogs. Sign up, get the courses you want, and get ready for the courses. When we get back from the Thanksgiving break, I will be doing some courses out there. I've got some courses to do for a couple of firms. I'm going to be doing a course, I believe at this point, in Connecticut. In that month, I'll be doing some courses in Arizona, including the current federal tax developments in Arizona that will be broadcast in December. So we'll talk about everything that's been going on in that regard. And we'll be doing, again, some of these rebroadcasts. Be sure to check your state societies. This week, I will be in Iselin, New Jersey on Wednesday the 20th. We will be talking about the Advanced Tax Update. Advanced Tax Update is like the stuff we talk about here. It's just a course where we assume that the people in the room have a number of years of experience so that we can talk at a higher level. And we can, you're not going to be a group of people who, if I make a reference to a code section, you're going to be totally lost in terms of what does he mean? What is that? We're not going to talk all code sections, but what we're going to do is assume that you have some background and assume that you have been doing this for a while. And we'll talk about things like the multiple state taxation problems, how those things run out. We'll talk about some more details about some issues that relate to representation of taxpayers. And we'll talk about the TCJA stuff that's coming. So if you're going to be in Iselin, New Jersey area, this will be at the APA Hotel Woodbridge, right next to the Amtrak station, Metro Park. I shouldn't say right next to it, but literally it would be walking distance. Yeah, it's really not very far. So, you can meet us there. We will go ahead and we'll have the course that day. So if you want to come out, sign up for it, check NJCPA's website to sign up for that course this week. This has been the Current Federal Tax Developments. I post my updates regularly at currentfederaltaxdevelopments.com. You can check them there, find out what's going on. You can follow me on Twitter. My address there is @EdZollers. You also can send questions and comments. The address is edzollers at currentfederaltaxdevelopments.com. You can follow me on various sites. I do watch the Reddit site /r/taxpros on Reddit. I also follow 3 state societies connect groups that I'm a member of, Arizona's connect group, New Jersey's, and Minnesota's. I also, do follow Cal CPAs. That has got a few bit of changes there about how you sign up for Tax Talk for Cal CPA. And if you have issues with that, you can email me and I'll tell you how to get that one signed up. But I do things there. Tax Talk is open to any CPA. You do not have to be a Cal CPA member to join it. Otherwise, we'll take a look at what's coming up in the coming weeks. Like I said, we got a whole bunch of guidance that we're supposed to have sometime before the end of January. You would hope at least some of it starts coming out. It doesn't all come out on January the 31st. So we'll keep our eye on what's happening there. We'll keep our eye on other developments. And we'll see you back here next week for current federal tax developments.